Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to help if you need. We're only 7 weeks into the year and so much has been happening. Share markets have been choppy, interest rates have been rising, there's all sorts of questions about the outlook for housing, and inflation is running hot in many economies, including our own. The COVID situation keeps changing, and there's definitely a high level of uncertainty about the outlook. I've asked Mike Jones to join me. He's a fellow economist who's been on earlier podcasts. And amongst other things, Mike's just changed the ASB house price forecast, which we'll talk about soon. So welcome back, Mike. How's the year started for you?
Thanks, Chris, and hi everyone. Yeah, like as you say, a bit of a sort of wobbly old start to the year for markets and economies. But for me personally, it's been a good summer. I managed to I was pretty happy to escape Auckland, like I'm sure many others were over the summer, and get down to Central Otago and run up and down some pretty big mountains, which was fun. My only sort of complaints, CDB, which you might share, is there hasn't been enough cricket on, but I'm pleased to see that rectified today with the start of a test match. So that's been good.
Yeah, we're both enjoy having the tests going on in the background. It's a nice way to get through the summer, that's for sure. So I'm like you. I'm looking forward to a little bit more action before the leaves start falling in autumn. Hey, and I know you've got a heap on at work at the moment. You've been working on the residential property market outlook, which I've hinted to, but also you prepare a lot of reports for corporates. So let's start with that. What are some of the big New Zealand corporates you talk with focusing on as we head into 2022? And how's this volatility that we've framed up this call looking to the companies you're discussing things with?
Yeah, look, it's an pretty easy answer this time around. I mean, two things really stand out. One is the tight labour market, and we are dealing with a labour market in New Zealand that may well be the tightest we've ever experienced, at least in sort of recorded history, and that's posing some real headaches for firms and trying to get labour in some specialist areas and just in general. As well. And the other, of course, which is increasingly the sort of topic du jour, is inflation. And that's coming through seemingly from all quarters at the moment. Input costs, firms are judging how much they can absorb and pass on. And at least in the short term, that looks like a problem that is probably going to get worse before it's better. And indeed, that's probably the case for the labour market as well. So it's sort of one of those cases in history where, the sort of macroeconomic picture that we talk about sometimes feels a bit abstract, is actually being felt quite acutely at the coalface of the economy.
Yeah, well, we can get on to inflation in a tick, but one of the things that you and I have talked about is that 2 years ago we thought COVID was a real game changer for the economic outlook. But for some of these issues like the labour market and where the economy's tracking at the moment, it's really been a pause for a little while, and we're now back to facing some of the problems that we faced in late 2019. The tight labour market being one of them, which has actually just got worse. Does it feel like that to you, that some things have just been paused and now they're back in play?
Yeah, we had discussed that before, whereby economists generally thought it was a game changer. COVID was going to upend the cycle. But in reality, it sort of paused the cycle, and we've re-strengthened again out the other side. And, there's also clearly a role that's been played there in terms of the stimulus that's been unleashed around the world, increasingly looking like global economy is actually overstimulated. So, hence why we've got labour markets, tight as a drum, and inflation, it's a real problem. So that's right. I mean, and that stimulus is I guess, something else that comes across for businesses. I mean, a lot of businesses were also obviously recipients of that. And, so where that's ended up has been an interesting issue in itself. A lot of it's clearly found its way into the housing market. We've talked about that before. There's also quite a lot, of cash that's sort of sloshing around on corporates' balance sheets. I mean, it's a mixed picture. Clearly hospitality businesses are under some real pressure. But I guess at an overall level, businesses are quite well funded. They've got a lot of, cash on balance sheets. Their sort of credit metrics are looking pretty good. The only thing kind of holding them back is being this caution around the COVID situation and the economic situation in general. But I think if we saw that fog clear a little bit, businesses might be in a pretty good position to be able to sort of invest and expand over the next couple of years.
Yeah, this is a theme that's came through with some of the earlier podcasts we've done, including one a couple of weeks ago, is some companies are doing really, really well. Their balance sheets look good, and they're hoping to be trading in an economy that's more open over the next 12 months than the preceding 24 months. But one of the factors in this volatility in share markets is if any companies disappoint, the market's very sensitive to that, and their share prices are getting hit significantly lower. It just seems that the market at the moment is very sensitive to this interest rate and inflation outlook and what it means for earning growth, when share markets are at pretty high levels despite the pullback over recent weeks. But hey, let's focus on inflation. So we were both economists in a decade where the problem was inflation was too low. It seemed to be the problem ever since, probably since Graham Wheeler came in as the Reserve Bank governor. And inflation over up until COVID was definitely felt like it was too low from the RBNZ's perspective. Then we had COVID, and now inflation's too high. And a lot of people talked initially about this being a transitory thing, and now are worried about it being more permanent. I know you've seen things slightly different. How's the general thinking changed over the past 6 months as people have started to worry about this being a bit more entrenched? And how's your thinking about inflation changed over recent times, Mike?
Well, mine hasn't changed too much. I mean, there's undoubtedly been signs that inflation pressure nearly everywhere in the world, with obvious exception just recently of China, but everywhere else, is coming in much stronger than just about anyone expected. But, for me, I guess we've discussed before, CTB, I kind of thought central banks were being a little bit too cute on this line that it was all going to be transitory. It was largely a story of these supply disruptions that were going to quickly fade, and inflation would quickly head back down to those sort of comfortable levels that central banks have been dealing with for the past real decade. I thought it's sort of an easy line to run in the middle of last year when we weren't at these high rates of inflation, that central banks were going to look through it and sort of sit pat as inflation corrected back down and was entirely transitory. But it's a much harder prospect to run that line when you're actually in the teeth of it, like we are now. Inflation in the US is 7.5%, and it's actually showing up in some of the really essential parts of consumer spending. Rents, food. So it's quickly actually becoming probably the biggest political issue in the US is in terms of replacing COVID. So look, I think we're probably getting pretty close to peak inflation in the next 1 or 2 quarters. We are seeing these pretty frightening numbers, 6, 7, even close to 8% in parts of the world where we're used to sort of 1.5 to 2. But the thing for me is inflation expectations and wage growth are starting to lift. And as you know, that those are the sort of self-sustaining processes in inflation that can actually keep it up high, sort of a self-fulfilling type argument that keeps inflation at those high levels. So that's the sort of thing that sort of central bankers lose sleep over. So for me, that's the real big question for this year is, how do the likes of, the Federal Reserve and the European Central Bank bring inflation back down to sort of comfortable levels by, chiefly higher interest rates without sort of tipping up the economic apple cart, because there's parts of the economies around the world that look a little bit fragile still and probably don't want to steer down much higher interest rates. So it's going to be a real balancing act, and for me that's the real big question for this year. And I think it's why we've already seen some sort of wobbly sentiment in equity markets, as you've mentioned.
Yeah, it's interesting that the whole thing about starting to see wage growth, which seems very important for the Reserve Bank of Australia in particular. That's welcomed by workers, but gee, at the moment, if we look at the last labour data, the wage increases people are getting are not even sort of half the inflation rate that we're seeing within the economy. So the poor old wage earners not getting anywhere in a real sense. But in this whole mix of things in terms of central bank action, it feels like there's a big contrast between the Reserve Bank of New Zealand front-footing things last year and starting to tighten monetary conditions, first through stopping their bond purchases and then hiking rates. And then we've got the Reserve Bank of Australia at the other extreme that still seem reluctant to hike rates until they see more wage inflation in the system. But it sounds to me and feels to me that all the central banks around the world have an awful lot of work to do. Is that what you're thinking too?
Yeah, I mean, I think the Reserve Bank officials probably had a slightly more comfortable summer than some of their counterparts offshore, having got those two interest rate increases on the board towards the end of last year. I know at the time, offshore punters thought we were all mad down here. Well, what were we doing actually tightening monetary policy at a time when we're still on a pandemic and there was new waves of COVID coming through? But now we sort of look like the brave Kiwi pioneers once again, having got a couple of interest rate increases on the board. And I guess if it wasn't for the Auckland kind of Waikato lockdown in August, we probably would have had one or two more. That sort of slowed the Reserve Bank's hand a little bit. So, yeah, I mean, there's a lot of work to do everywhere. I think, for me, I think about it as kind of like the year of delivery for central banks. A lot of the hard work, particularly for the Reserve Bank of New Zealand, was done last year in terms of, actually going, hang on, we need to change course here. The economy doesn't need this sort of stimulus. They wound up the bond buying program. They changed their communications to say, hey, we're actually we're going 180 here. Interest rates are going up. And they've set the markets on a course for higher interest rates. So now what they have to do this year is essentially just deliver on that with a lot of the sort of the comms work being done.
Yeah, for investors, we typically look at the share market when portfolio valuations decline. But for New Zealand investors, if they've got an income focus, that aggressive action from the Reserve Bank and the fact that our rates have moved so much over 2021 is really noticeable in their investment portfolios. And it's a tricky thing to explain, but as well as the share markets being jittery at the start of this year, these increases we're seeing in interest rates within the economy are meaning that bond portfolio valuations are down. So ultimately, I think it's good news that we're moving back to a more normal interest rate environment. That's good for the running yield of a bond portfolio. But the transition is a big headwind for returns, and we can see that over the past year. Now, another thing I know you think about is the New Zealand dollar. It's quite a bit lower now compared to times last year and earlier when it was trading in the sort of comfortably in the 70 cent plus range against the US dollar. That's another thing which is going to be adding to inflation pressures over the year ahead as the cost of imported goods goes up, but it's helpful for exporters. What's your thoughts about where the New Zealand dollar is trading at the moment, and do you think it's going to garner some support from rate hikes, or is it going to be more influenced by perhaps what's going on offshore where they'll be hiking rates as well?
Yeah, it's a good point. I think the New Zealand dollar is one thing that has surprised me. If you think about the normal fundamentals that kind of drive trends in currencies, for the Kiwi, there's two big ones. One is the prices that our key commodity exports fetch offshore, and the other is how our interest rates are going relative to the rest of the world. And both of those last year were a big screaming green arrow, and yet the currency fell, which I guess highlights the old issues around trying to pick currencies. It's always pretty tough, but yeah, this kind of cycle in particular seems quite odd. I mean, it's a really big boon for, I think, the likes of farm incomes. You don't normally see really high commodity export prices and records in some cases if you look at the payout forecast for the dairy sector. At the same time as the currency goes down, normally those things move together. I think the last time we saw something like this was probably 2001, so sort of 20 years ago. So it's a really, it's a big boom for us as a sort of an exporting economy. Pretty sort of reluctant to wait until where it goes from here, given I almost can't understand why it's here in the first place. If last year was the year where New Zealand interest rates sort of took off, this is the year where the sort of rest of the world catches up, I think, to some degree. So you've seen that, I guess, in the US in particular. US Federal Reserve's kind of scrambling to quickly wind up its easy monetary policy, its bond purchases, and actually get cracking on interest rate hikes. They might start with a double, in fact, so get some really quick runs on the board. And even in Europe, wouldn't have ever said inflation and Europe in the same sentence together for probably the past 10 years. But even the ECB's now looking like they'll come to the party and deliver higher interest rates later this year. I think, if the rest of the world interest rates catch up or rise more than ours, that's probably something that keeps that New Zealand dollar at lower levels than otherwise. But yeah, it's a tough old job trying to pick where the currency goes. But in the here and now, as you say, it is, it's relatively low, and so it is contributing to inflation, where normally the Reserve Bank would sort of see the exchange rate as having its back. When it's raising interest rates, the currency would be going up as well, and helping the Reserve Bank to keep inflation lower.
Yeah, I'd concur with those comments about FX forecasting being a tricky game, and my 3 years in the team forecasting foreign exchange, I think, is the reason why I've got so much grey hair, or it's falling out. It's hard work. But in the investment management space, currency hedging is clearly an important part of the decision, particularly to try and reduce some of the unwanted volatility for income assets. But let's get back to where interest rates are, or where the rubber hits the road for interest rates, and onto those housing market conversations that I've been hinting at. One of the things for homeowners is what's the outlook for mortgages, and I think there's an awful lot of the RBNZ's rate hike expectations already baked into our 5-year mortgage, for example. It's up by over 2% from the lows, even though we've just really started the rate hike cycle. And it's weird to think interest rates have gone up 2% for a 5-year mortgage, but that's still an incredibly low rate on a historical basis. Did the speed of the changes in mortgage rates and longer term borrowing costs for businesses surprise you last year? It just seemed to come really quickly through the second and third quarters.
Yeah, yes, no. I mean, yeah, we've talked about it before on these podcasts, CDB. I mean, it did look like sort of for a while there the only way it was up for mortgage rates. But yeah, in terms of the speed of just how quickly they've increased, that probably has been a bit surprising. In fact, according to the numbers in a recent report I wrote, probably the most rapid increase in mortgage rates in about 15 to 16 years, which is kind of important, because if you look at housing markets, as I do, what you can find is it's not always the level of mortgage rates that really matter for the trend in house prices, because the level, of course, is still quite low relative to history. It's not as if we're up 8-9%, but it's actually the speed with which they change, because that's what sort of feeds through to mortgage borrowers' back pocket. And again, Reserve Bank puts out some numbers, shows that about 60% of all mortgage holders on fixed rate mortgages are going to roll their debt or roll those rates over in the next 12 months. So that's a lot. Would sort of describe that as quite a short book for mortgage rate refixings. So those big increases that we've seen, are going to come through and be felt in terms of the real economy in pretty short order, and probably contribute to perhaps a lower pace of spending. We've seen a real boom in durable spending. Everyone's rushed out and bought, new TVs and fridges and sparkles, but there is going to be a little bit of a crimp coming, I think, in the wallet from those high mortgage rates. Oh,
and add in $3 a litre petrol, and you can understand why people's wallets will be under a bit of pressure later on in this year. And hey, I know that the mortgage forecasts are a cog in the wheel of your overall thinking, but there's lots of moving parts with your outlook. So can you talk us through some of the other key drivers for your forecasts and your thinking, and the latest changes you've made? I noticed this week you put out your latest report on the housing market and lowered our forecast for prices this year. Can you chat us through that? Yeah,
the long and short of it is that, this year, 2022, is looking like quite a different year for the housing market. And I put out some notes last year, basically, flagging a bit of a health warning around house prices this year, because it looked like we were going to get sort of three macroeconomic boogeymen all sort of showing up at the same time this year. That was the sort of risk, and it does look like that's happening. Those being, one, quite a bit higher mortgage rates. The second being some quite clear lifts in the supply side, so more houses coming onto the market thanks to the big construction boom we've seen. And the third being a tightening in credit conditions, so less kind of easy credit for those looking to borrow to buy houses. And we are seeing all of those things sort of occur at the moment. And I guess the credit tightening side has had a bit of press, partly related to the changes to the CCCFA Act, partly the Reserve Bank's tightening its loan-to-value restrictions again. It's quite hard to know which one of those is kind of doing the work, but it does seem, if you look at things like house sales, that markets really losing steam probably a bit earlier than we might have thought. We had some small falls in house prices forecast for the second half of this year, really a mortgage rate story in the main, of about 3%. But it now looks like that tipping over of sentiments come a bit early, probably, as I say, thanks to the credit side of things tightening up. So we've sort of doubled that. So now we see house price falls of about 6% by the end of this year. So that's kind of small falls over the first 3 quarters and then perhaps a bit of recovery towards the end of the year. So, yeah, as I say, it is a different sort of picture. Overall, you can kind of characterise it as all of that excess demand that I guess bid prices up so aggressively has started to drop out. So, as I say, with the supply side rising, we're seeing a much more balanced market, which is ultimately a good thing.
Yeah, and one of the things that you and I have both scratched our heads over in the past has been working out what the actual level of migration is and what that's adding to the equation. Now, we've been able to scratch that off our job list over the past couple of years because there really hasn't been any. But that's another variable that I guess will be adding to the mix and adding to the story that we ultimately get over the course of the year.
Yeah, that's a great point. I mean, migration is normally such a big and important factor when you're thinking about, housing demand in New Zealand and hence the prices of those houses. But it was probably the thing that threw all the economists, including myself, off the scent really when the borders shut. And suddenly inward migration effectively stopped overnight. Most people thought, well, that's a big hit to demand. House prices might fall quite a lot. And in the event, Kiwis without any migration were quite capable of generating the housing boom all by themselves, and the opposite happened. House prices actually went through the roof as we saw. So what does it mean when we see migration restart again? A little hard to know given that, but I think it is probably something that just helps, shore up demand, along with, as I mentioned earlier, a really strong labour market. I mean, labour incomes, not only is, just about everyone that wants a job can find one, but the income from those jobs is increasing too with wages. So, strong labour market incomes are normally, associated with a reasonable house price backdrop. So that's one thing that'll, I think, provide some support. So we're not talking about any sort of material correction in house prices. In fact, if our forecast for a 6% fall this year came true, that would only put national house prices back to where they were about the middle of last year, middle of 2021. So, it certainly gives you some perspective.
Migration, it's going to change over the year ahead, and then that's probably got implications for the labour market outlook too.
Yeah, that's a good point, CTB. And I think the reopening of the border and what that means for the labour market is probably a whole podcast topic in of itself. But suffice to say, I don't necessarily think it's clear that reopening the border is going to lead to a material loosening in the labour market in New Zealand, and maybe that actually more Kiwis head back offshore to pursue opportunities out there, and we actually get things tightening up here even further. So that's, I guess, one of the big uncertainties we're grappling with for later this year.
Yeah, we pondered the same question in the global financial crisis, and once we could, Kiwis did want to resume their travelling ways, but that, like you say, maybe that's a subject for a podcast down the track. Yeah,
and I think probably the bigger driver of the labour market later this year is going to be just how much of a rebalancing we see in the economy. So we've had this sort of slightly tilted economy where a lot of stimulus has found its way into the housing market. We've had really strong consumer spending on the back of that. But now we're starting to see that slow up, and we're starting to see the baton shift to the export sector, given those really high commodity export prices. And so that rebalancing, hopefully bodes well for a bit more sort of balance in it and some of the other key parts of the economy we look at as well, like the labour market.
Cool. I made a note to check in on these issues with you later in the year for another podcast. So thanks for that. But we've got a lot of investors that are using bank products, including KiwiSaver, to save for their first home. And so I'm pretty sure they'll like the sound of prices dipping, or even just the fact that they're not rising and running away like they were at stages in last year and the year before. So, even if we saw a 10% drop in prices, that affordability issue is still going to remain, and saving for a home, getting some good advice and making sure your money is in the right place just seems as important as ever as we head into quite an uncertain year. Hey, so thanks for joining me today, Mike. There's just some great insights that you've been able to provide, and some really interesting details behind your thinking and forecast. So thanks for your time.
No problem at all. Pleasure as always.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, please get in touch at podcasts@asb.co.nz.